You would have heard about your friends and families saying that you should invest your excess money after which you save in S&P 500. So what is S&P 500? So is it worth investing in S&P 500? And what are the ways you can invest money in S&P 500 in? That is the thing we're going to say in today's video. The S&P 500 index tracks the largest companies in the United States. Its stocks are curated by the S&P 500 Index Committee, which selects companies based on a number of factors, including market capitalization, sector allocation, and liquidity. The index is traditionally made up of 500 of the leading US companies, although that number may fluctuate. The S&P 500 represents approximately 80% of available US market capitalization. The index includes companies across the spectrum from energy to healthcare. Here are the top 10 companies in the S&P 500 by index weight as of September 2023. Most of these companies fall into three main sectors: the information technology, which constitutes 28% of the S&P 500, consumer discretionary, which is 12%, and communication services. These three sectors account to almost half of the S&P 500. So how do you invest in the S&P 500 index? For new investors, the best way is through an ETF or mutual fund. While there are some differences between the two that we will explain below, funds are a low-cost way to gain exposure to the S&P 500 and provide instant diversification to your portfolio. Now let us look at the two ways to invest in the S&P 500. To invest in the S&P 500, you can buy stocks of the individual companies in the index, or invest in index funds or ETFs that replicate the index. Step 1. Open an investment account with a broker. In order to buy investments, you will need to open a brokerage account if you don't already have one. You can use the money you deposit into the brokerage account to purchase S&P 500 stocks or funds, which will then be held within that account. It may be advantageous to consider what type of investment account you want to open, since some have significant tax benefits. Step number 2 is to choose your investments. Decide if you want to invest in individual stocks included in the S&P 500 or a fund that is representative of most of the index. Investing in an S&P 500 fund can instantly diversify your portfolio and is generally considered less risky. S&P 500 index funds or ETFs will track the performance of the S&P 500 index, which means when the S&P 500 does well, your investment will too. Once you have made a decision, you can simply follow the instruction within your brokerage account to purchase the S&P 500 investment you have decided to buy. So how much does it cost to invest in the S&P 500? If you want to invest in the S&P 500, there are a few costs to consider. If you are investing in an S&P 500 index fund, if your index fund has no minimum, then you can usually purchase in any dollar amount. If your index fund has a minimum, then you have to purchase at least the minimum amount. If your index fund has an expense ratio, you will be charged as a fee. An expense ratio is an annual fee expressed as a percentage of your investment. For example, if you invest $100 and your fund has an expense ratio of 0.04%, you will pay an annual fee of $0.04. If you are investing in an S&P 500 ETF, they trade similar to stocks and have a share price. Depending on your broker, you will either need to pay the full share price or you can buy fractional shares for any dollar amount. Similar to index funds, ETF often have expense ratios. So make sure you see how much you would be paying in fees to invest in a given ETF. If you are investing in a stock within the S&P 500 index, stocks cost vary significantly. Some stocks in the S&P 500 cost under $100 and others cost $500 a share or more. Be sure to look at each stock share price before you make a decision to buy. So should you invest in an S&P 500 index fund or an S&P 500 ETF? While all S&P 500 funds track the holdings of the index, an investor must consider whether using an index fund, which is usually a passively managed mutual fund, or an ETF makes the most sense for them. There are several differences to consider. For example, ETFs can be bought and sold whenever the stock market is open, while mutual funds can be only bought and sold at the set price point at the end of each trading day. So my suggestion to new investors is that when learning how to invest in the S&P 500, and buying a fund over handpicking individual stocks. Here is why. Passively buying and holding an index can produce better results than individual stocks. A buy and hold strategy also minimizes the effect of market volatility and increases your odds of seeing the positive returns the market has historically provided. From 1950 to 2021, the S&P 500 has yielded an annualized average return of 11.18%. So what are the advantages of investing in S&P 500 index? Some of the benefits of investing in S&P 500 include exposure to the world's most dynamic companies. Investing in the S&P 500 gives an investor exposure to some of the world's most dynamic companies, such as Apple, Amazon, Google, and Tesla. It provides consistent long-term return. Although returns in any single year can vary widely over a long-term period, S&P 500 has been a consistent performer. Another advantage is it doesn't require an intricate analysis. Investing in the S&P 500 through an ETF or index fund means that you don't have to spend hours analyzing and picking stocks in a futile attempt to beat the market. Another advantage is it can serve as a core holding. S&P 500 index funds and ETFs are very liquid and trade with tight bid-ask spreads. This makes S&P 500 funds and ETFs ideal as a core holdings for most investment portfolios and makes them suitable for advanced strategies like covered calls and hedging. Let's now discuss some of the disadvantages of S&P 500. So the following are some of the main drawbacks of investing in the S&P 500. 1. The index is dominated by large cap companies. The S&P 500 is dominated by large cap companies, with its 10 biggest constituents accounting to almost 1/3 of the index. This means that the S&P 500 index does not have exposure to small cap and mid cap stocks that may have the ability to grow much faster than the large cap stocks. The next issue is the index has risk inherent in equity investing. The S&P 500 has risk inherent in equity investing, such as volatility and downside risk. For example, the index lost almost 1/3 of its value in the space of a few weeks in March 2020. Newer investors may find it difficult to tolerate such volatility. Another disadvantage is it only includes US companies. The S&P 500 only includes US companies and excludes companies in other parts of the world, such as Asia and Europe. The bottom line is, investing in an S&P 500 index fund is a great way to diversify your portfolio. Whether you choose an ETF or a mutual fund depends on how much you can afford and what your goals are for the future. Regardless of which option you choose, you'll likely see some consistent returns. Make sure you have the right brokerage account for your needs so that you will save on fees and commissions. Brokerage accounts are financial accounts through which investors hold, buy, and sell various assets. Brokerage accounts are offered by broker-dealers, investment companies, and online trading platforms. Several types of brokerage accounts exist, serving different needs and with different tax structures. Some brokerages also offer access to proprietary investment products like mutual funds that are exclusive to them or a particular investment firm. Your money in a traditional bank account is available in cash. It can be withdrawn immediately, but money in a brokerage account is invested, tied up in individual assets. So if you sell something, it may take a day or two before everything clears and you actually receive the funds. Brokerages typically charge annual fees to service and maintain your account. Clients may also be expected to pay commissions or transactions, the actual purchase or selling of the securities. That's all for today's video. Let us know your thoughts in comments below and subscribe to the channel so that you don't miss any of our videos on personal finance and you get notified. Thank you for watching. See you again next time.